Hello, welcome back. Today we're going to talk a little bit more broadly about the banking system, about how it works in general. This will give you the background to understand the larger scale cases that are going against the banks in general at the moment. If you're only interested at the moment in the urgent matters of getting your car back or not getting your house repossessed, you might want to skip this one for now. But I do recommend that anybody that's in trouble with the banks get to know a little bit about the whole system. So we've got a series of lectures on that so that you can understand what's going on overall, what is a problem in the banking system, what isn't. This is from a book I wrote about more than 10 years ago. In fact, the first edition was more than 15 years ago, so we've got a new name now. And this particular one I think was 2002. But I've got a chapter, My Privatisation for Prosperity. I'll just summarise the points before we go into them, because it's quite complicated monetary economics, but it's worth understanding. Firstly, the expansion of the money supply, the total amount of money in the country, is what causes inflation, and is, in my view, a wholly negative phenomena, or a net negative phenomena. Zero money supply growth, and zero growth of the money supply should be the target, and it has many benefits. Now, when we're talking about money here, we're not talking about wealth. Obviously we want wealth to increase for everyone, but we don't want the amount of money to increase, the amount of notes and coins, the amount of banking transactions, the amount of credit. So that's what we're talking about. The main reason why money supply in a country goes up is because of bank lending. What happens is the central bank, either through interest rates or by controlling the amount of reserves that a bank has to hold with it, controls the amount that banks are able to increase the money supply by, and we'll explain that a bit later. So the key is to reduce the growth of bank lending. We want a fixed supply. Although non-bank lending such as corporate bonds and other types of lending are fine and they should be allowed to grow. Some people, I'm just summarising here, I'm going to go into things in a lot more detail. Some people argue that because banks only keep so much in reserve and then lend out the other 80%, the only way to stop it is to make 100% reserve. So when you put deposits down, the banks don't lend them out. I don't think that's a solution, and in any case, if we moved from what at the moment is maybe 3% reserves, 10% reserves, 7% reserves to a situation with 100%, the money supply would contract so dramatically that it would cause huge economic devastation. So what we really want to do is fix the amount of money in the economy, not the amount of wealth, but not by making 100% reserves, but maybe fixing the reserves where they are, or through interest rates, or just pass a law to say banks are not allowed to increase the money supply unless, so they can't create new deposits, because what banks do is they create a deposit when they lend, and that deposit then becomes the basis for further lending. And what actually constrains bank lending at the moment is just themselves. They don't want to lend too much and make themselves too vulnerable, but apart from that there's very little constraint on what they do, apart from the reserves they've got to hold with the central bank. This is the same in every country at the moment, as far as I know. Now, the other thing, apart from reserves, and the two things are often confused, is that banks borrow short and lend long. So in other words, when you put your deposit in a bank, usually you can get it out whenever you want. However, when they take that money and then they lend it to somebody else. Now when they lend that to that person, they're probably lending over the course of a mortgage, which is 25 years, so they can't get that money back easily. Now we'll talk a little bit about securitization and how that in actual fact helps with this problem. But if there's a bank run, if everybody wants their money back at once, well, the banks lend it out in long loans and can't get it back, so that's what causes the problem. Now some people argue that that is in itself fraudulent, that they've said we promise to pay the bearer on demand, or you can get your deposit back whenever you want, and in fact in a bank run you can. But all banks really should be doing is changing their contract to say we may not be able to pay you in a bank run, but we'll pay you interest at this amount and we'll give you the money back within this many days when the bank run stops, or whatever. And then contractually there wouldn't be a problem. So that's not the essence of the problem. The essence of the problem is this phenomena where banks increase the money supply, and that makes everybody, if you can think, there's a relationship between the amount of money in the economy and the amounts of goods and services. Now, if you double the amount of money overnight, or in a month or two, like has happened in the Weimar Republic in Germany in the 1920s, in Latin America throughout the 20th century, in Zimbabwe recently, you know, if you increase the amount of money available dramatically, then the money just becomes less and less valuable relative to goods and services. So there's this relationship between money and goods and services, which if you keep the money supply constant, then the price of goods and services should be coming down every year a little bit as productivity increases. So that's what should be the case. I would call it the normal way, but of course it's not normal because nobody keeps the money supply constant. In history, it's actually, money supply has been increasing a lot more since we've invented, you know, electronics and paper money in the 19th and 20th centuries, or at least started using it a lot more. In history, there's been cases where you've had stable money for hundreds of years. The Byzantine Empire for almost 800 years had stable currency where there was no inflation. So it's possible. In other countries, the kings would take bits of gold from the coins and debase the coinage that way. That was the inflation of that day. It's harder to do that than it is to run a printing press at the government central bank to increase inflation. So we've got far more capacity technologically to create inflation than we did before, which is why only now we really have to address the problem. So that's an introduction to money supply economics. So let's leave it there for now, and we can come back on another day for the next lecture. Thank you.